Welcome to Thought-Provoking Ideas. I make videos to help create awareness to empower positive change. Today, we'll be exploring the topic of debt, what it is, and how to get rid of it faster. I'd like to remind you that the information presented in this video is general in nature and does not constitute personal advice. I am not a financial advisor, and the information has been prepared without taking into account your personal objectives. You can read my full disclaimer in the description below. So what is debt? Debt can be defined as a sum of money that is owed. This generally occurs when a person borrows money to make a purchase for a product or service. Individuals generally take on debt as an option because they can't afford the purchase or prefer to purchase investments that they believe will be more profitable than the interest rate incurred for owing the debt. For example, margin lending or redrawing from your home loan. This of course comes with its own set of risks, as no investment is guaranteed to be profitable. The Reserve Bank of Australia, January 2021 credit and charge card statistics, as shown in canster.com.au, states that the average Aussie owes $3,925 on their credit card, has a personal debt of $21,200, this excludes credit card debts and property loans, and has a mortgage of $540,166. This may be higher or lower depending on where you live. Further to this, almost 30% of respondents to the latest news.com.au cost of living survey say that they are struggling with debt to such an extent that they believe they'll be carrying it for the rest of their lives. Debt management is important for anyone trying to work towards financial security. This is in everyone's best interest. With interest rates so high, it's more likely that debts could spiral out of control and even possibly result in the interest owed exceeding the principal borrowed. This can either result in extremely long debt repayment periods or no longer being in a position to pay off the debt at all. Regardless which of these are relevant, both result in deferring one's ability to save and get ahead. In a worst-case scenario, it could result in bankruptcy. In all cases, debt repayment requires discipline and hard work. However, there are a few things one can do that may help you pay off debt faster. As the analogy suggests, the snowball method starts small. However, as it gains momentum, it increases in size and impact. In other words, the snowball method targets the smallest debts first. Once the smallest debt has been paid off, the next smallest debt is next. This is a popular approach from the perspective of positive psychology, as it can trigger a sense of accomplishment, increasing motivation and the building of momentum to tackle the bigger debts. Although mindset is important to be consistent, if you want to get rid of debts faster, this is not the best approach. True to the destructive impact of an avalanche, this method tackles debts head-on with the highest incurring interest rate debts first. Mathematically, this approach is the most effective and will get you ahead at a faster rate than the snowball method. Regardless which method you decide on, always be sure to pay at least the minimum repayment amount on all your existing debts by the due date. Failing to do this may result in consequences such as incurred interest, late fees, details added to your credit report making it harder to get new loans approved. Benefits may be removed such as interest-free period or rewards, default notice, referral to debt collectors, and legal action. The further down the list you go with regards to these consequences, the harder things become on you. Believe me, you don't want the headache. Consolidation of debts is an effective method whereby one essentially takes multiple debts and brings them all together into one single loan. Refinancing, on the other hand, relates to a debt, for example a property loan, a personal loan, credit card debt, etc., and renegotiates the terms of that loan under more favourable terms, either with an existing lender or another lender. Some benefits of consolidation and refinancing can include the simplification of debt repayments with one easy-to-pay loan, reduction of interest rates, fewer or reduced repayments each month. However, this can also be counterproductive and can result in higher repayments over the long term. This can occur if only the minimum repayment is paid for the new debt over a long period of time. And also additional benefits from lenders, such as unsecured loans, fixed interest rates for life of the loan, flexible repayment options, and no early payment fees. Before choosing this as an option, you should always do your own research and seek professional financial advice. This is because considerations need to be made before deciding if this is the best option for your circumstances. These considerations could include, but are not limited to, comparison of interest rates, fees and charges by the new lender, exit fees or penalties charged by the existing lender, or impacts on your credit score. The repayment amount and frequency of your debt can speed up or slow down the rate at which you pay off your debt. Higher and more frequent repayments are more advantageous than lower and/or more spread out repayments. For example, assuming that interest charged is calculated on a daily outstanding balance, if you have the opportunity to make weekly repayments rather than monthly repayments, considering the weekly repayment option will contribute to paying off debt faster due to compounding. Essentially, if your debt repayment balance is less as a result of this strategy, you will be paying interest on a lesser amount. Sometimes, debt is completely necessary in a goal to get ahead. For example, a HECS debt may act as an investment in yourself with the plan of securing a higher paying or more secure job in the future. A home loan is another example, as in time, you have the peace of mind in knowing that you own the roof over your head and the asset may have appreciated over time. However, there are many who take on debt for temporary material gain or lifestyle. It may almost be impossible to pay off debt if the way you view your spending does not change. Taking a closer look at your purchases and really questioning if they are necessary can help reduce the risk of getting further into debt. Things to consider are: why do I purchase this? What value does this purchase offer? Do I need it now, or can it wait until I have saved up the amount? Once saved, do I still want it? Do I still need it? How long will this purchase give me pleasure for? How does the cost or debt of this purchase compare to the savings and growth of my savings if I didn't purchase it at all? Which is more important to me? Lastly, how much time would I need to spend at work to pay for this? Is my time more important, or is what I'm purchasing? Just a quick pause to say, if you're enjoying this video so far, please give it a thumbs up so that this video could potentially reach more people. Discipline is an important characteristic in an attempt to pay off debt or save. Once you've decided on an approach that is tailored to your circumstances, stick to it. Setting up automatic transfers is a great way to take the thinking out of it. If repayments are made to your debt first, you are less likely to miss that money. This is also common practice used by those who are saving money. There are times that things may get tough and will result in it being tempting to defer from your plan. Try to find alternative strategies to make sure that you stick to your plan. The importance of this is relevant to many different aspects, but mostly our mindset and our emotions. Sticking to your plan is empowering and will help cultivate good habits, whilst breaking your plan can reduce resilience, which could result towards bad habits. If you have watched my previous videos, you would know that I'm definitely all up for saving and having an emergency fund up your sleeve. However, when debt is involved, it might be worth breaking the rules. one has to question whether it is more worth using your savings to pay off existing debt in the long term. This one is a bit of a balancing act and may differ depending on your personal situation, so consider yours and determine what the best approach is for you. A great strategy to get rid of debt fast is to pay it off as fast as you can. There are lots of strategies available which can help you earn a little more money to put towards your debt repayments. You can view some of my current videos on some simple changes that can help you save more money for some ideas. Whatever amount you can earn or save as extra, put it towards your debt and get it paid as fast as you can. I'll be making another video shortly on some ways that you can earn extra income. This is also known as side hustles. Probably the best strategy with regards to debt is to try to avoid it in the first place. This may not always be an option for everyone, particularly those seeking a mortgage to purchase a property. For other types of debt, however, where possible, if you can avoid it, you should definitely consider this as an option. Paying off higher interest-bearing debts should always be the priority. Paying off debts fast should include your home loan to give you better security. However, this is not the preferred option by everyone, as there are many considerations one could take into account. Thanks for listening, everyone, and I hope you found the information in this video valuable. I'd love to hear some of your comments on different ways that you use to get rid of debt faster. If you haven't already, please subscribe, and you can also follow me on Instagram and Facebook for regular content. Thanks everyone, and have a great weekend. Catch you all next week.